Hey guys, welcome to the Juniper Links accounting channel. My name is Caroline and today we're going to look at how to close a UK limited company. So I'm going to go step by step with what you need to do before you can actually close it down. I'm going to include some of the pros and cons of actually closing the company. And finally, I've got an example for you guys with a personal tax calculation of when you do actually shut down a company and receive money and what happens with that money. So without further delay, let's get started with the video. Alright, we are in my computer and today we're looking at how to close a UK limited company. So why are we looking at closing a company? So there's a lot of different reasons, but the most common in our case is going to be that the company has ceased trading and you just don't need it anymore. Or if you started a new company and were pursuing something different and you no longer needed your old company, then you'd want to probably close it down because there's just no need to have it. Or the other options are something like taking a long break from contracting, so you know you're not going to be a contractor for quite some time. And you can close a company for just a 1-year break as well. But in that case, if you know you're returning to contracting or you're pretty confident that you will be, we wouldn't recommend claiming entrepreneur's relief because there are some rules around this that wouldn't let you. So I'll get into that in a little bit here, but don't worry about that for now. We'll start off with some of the cons of closing a limited company. So first and foremost, the company will no longer exist. That is true, and there's not really anything else you can do about that. It is possible to reopen a company, but it can be very costly, especially if it's to release funds taken by the government under bona vacantia. And what this means is vacant goods. I will get into this in a later part of the video, but basically it's when either Companies House closes your company for you because of a late filing that was never done, and they take whatever was in the business bank account as vacant goods basically, and they now own that property because there was no owner for it. And the only way to get it back is to reopen the company and also submit any late accounts and other penalties. In a lot of cases it won't even be worth opening the company to do that. Because things like corporation tax and stuff will need to be paid, so that will require separate legal advice. But that is one con of having a company closed down, and this is not necessarily you choosing to close down a company. In some cases you can choose to close down a company, but you forget to take the money. Government will take your money that's in the business bank account at the time of closure and you can't get it back. So I'll get into how to avoid this, but that is one of the cons. The other one is the targeted anti-avoidance rule, or TAR for short, and this is in relation to entrepreneur's relief. So this is what I mentioned in the beginning, where you probably won't want to claim it if you're planning to reopen the same kind of company in less than 2 years' time, because HMRC will not let you claim the entrepreneur's relief in that case. It would be seen as tax avoidance, and I'll explain that in a minute. HMRC can stop the company closure if taxes are still outstanding. Now, this isn't necessarily a con because you should have paid it anyway, but you'll have to make sure that HMRC is happy with your company's tax standing before you go ahead and shut it down, because you actually won't be able to. And you will need to arrange a liquidation for insolvent companies where they cannot pay creditors and or taxes. So yeah, you'll have to specifically get legal advice with that and make sure it's all done. So those are some of the cons of trying to close your company. And pros, you can claim entrepreneur's relief if the company was trading for at least 2 years. So since the company set up to when the company ends, so start dates to the end date has to be 2 years in order to claim this entrepreneur's relief. This is basically reduced capital gains when the company is shut down and all the remaining assets are distributed to shareholders. So another pro of shutting your company down is it's really pretty easy to set up a new one if you ever wanted to. So you do have the option to do that again. You just have to start everything over, which is just a case of getting the company set up, getting a business bank account, and registering for any taxes that you may need. The new company can also have the same name if it's still available on Companies House. You obviously don't need to pick the same name, but if it is available, then it's possible to have that name again. You can also choose to take dividends and or capital distribution from the remaining assets in the business. In most cases, for companies providing consultancy services such as IT contractors or project management type stuff, or business advice and business management, you will most likely only have cash in the business as an asset to distribute, which is just going to be the remaining balance in the business bank account after all taxes have been paid. And you can choose to take either dividends or capital distribution. Now, the main reason to possibly take dividends, or at least partially dividends, is that you will need to basically get a members voluntary liquidation service for solvent companies with assets over 25k. So let's say your company's assets worked out, wow, that is a euro sign, to 30k. It might be worth just taking that extra 5k dividends to reduce it to 25k, and that 25k can be a capital distribution from the business, which, if you get to claim entrepreneurs relief as well, is going to be really, really tax efficient. So I will get into an example at the end of the video, so don't worry. Basically, this members voluntary liquidation service can cost a bit of money, so if you're not distributing that much, it might just be worth declaring a dividend at the end of the year and then taking that 25k amount as a capital gain. I will get into the steps of how to actually close the company here. First things first, you must produce a final set of accounts for the company. You can change the year-end date if that makes sense for you, but just keep in mind, if you've already extended the year-end, you can only do it once every 5 years, but you can shorten the period as much as you want. The next step will be to determine the total value of assets at the year-end date. So this is going to come from the actual accounts, and this is most likely just going to be the cash value. If the company has any assets at the end of the year that need to be sold, then that needs to be assessed as well, and to work out the total gain you'll basically be able to recover from the company. If the remaining profit is, or distributable reserves, whatever you want to call it, is over £25,000, you will need members voluntary liquidator, and this is a service you must pay for. It's not recommended to take money from the company before the year-end date, and let's say you knew that there was going to be a capital distribution and you just wanted to clear the business bank account balance before the year-end date. Well, unfortunately, all of that money you've just taken is likely going to just be a dividend. The best way is to kind of understand what the end figures will be before the year-end date. If you need to take a dividend, then declare a dividend, and then you must wait until the year-end has passed, and then you can take the leftover money in the business account, which will be distributed as a capital gain. The next step is to ensure all the creditors are paid, which is HMRC for these various taxes, so PAYE would also be in there, and also any bills you've got to other companies, because they will need to know that your company is being closed down. And if you've not paid them for something, they can potentially stop your company from being closed down as well, which is not ideal. So yes, make sure all bills, everything outstanding has been paid. The final step, which is possibly one of the most important steps, because this can get people into a lot of hassle, is to clear the business account balance when everything has already been paid. So everything left over, clear that out and pay it out to yourself or to other shareholders if there are any. Otherwise, when you submit the application to close down your company, the bank account will be frozen and all the money will be taken by the government as bona vacantia or vacant goods, and you don't want this to happen because it is gone. You basically have to get the company reopened to get that money back. Okay, and the personal implications of closing a limited company, so the steps to keep in mind when you're doing this, or when you get someone else to do it. Take the remaining funds in the account after all taxes are paid, so that's kind of carried on from the company's responsibility as well, because it has to clear the business account. The total dividends or capital distributions that you received, just cross that out, but whatever. Total dividends and capital distribution value that has been determined with the accounts will be received basically by you personally. And that means it will be declared on your self-assessment as just normal dividend income or a capital gain. And when you're doing the self-assessment, or if your accountant's completing it for you or something like that, they can potentially claim entrepreneurs relief, which reduces capital gains tax to just 10% for anything over the tax-free allowance. So this is actually very tax efficient, very good on taking large sums of money. And there are some rules on when you can claim this relief, which I'll get into. Capital gains are added together for the entire tax year, so remember, if you've got any other capital gains, they'll be added to the gain you receive from the company. Qualifying gains for entrepreneurs relief, you only pay 10% tax, like I said, and the first £12,000 of capital gains are tax-free. So this is specifically for the 2019-20 tax year, but there is usually a tax-free allowance every year. Okay, so I touched on this targeted anti-avoidance rule previously. It prevents business owners from receiving tax benefit from entrepreneurs relief by closing and reopening companies. So it specifically targets individuals who own more than 5% of shares in a company. So if you own your own company, you'll be 100% shareholder. If within 2 years of closing the company, you're involved with another company of a similar trade, so if it's like a similar service that is providing or whatever, HMRC will kind of be like, well, that's the same company, you've just closed it for tax relief, basically. Why did you close it if you're just going to carry on being involved with the same type of company? So, and the third target, of course, is the main purpose of the arrangement, is to receive tax relief. Obviously, this one is up to interpretation if you can prove it, but what HMRC will do is automatically assume that it's for tax relief if it's been done within 2 years. So if you're involved with another company of the same trade or similar trade within 2 years of closing the previous one, then HMRC is automatically like, wow, you did that for tax relief, you cannot claim the entrepreneur's relief. Unless you can prove to them that it was not, which is going to be difficult. So this is what the targeted anti-avoidance rule does. Okay, and capital gains tax. This is going to be our last point here in the video, and the next one's going to be an example. So if a company is open for 2 years or more, you can claim entrepreneur's relief. In most cases, if you're involved with another company in a similar trade, you won't be able to claim it because of that targeted anti-avoidance rule. Capital gains tax-free allowance this year is £12,000, and the normal capital gains tax rates are 10% in the basic rate threshold. So for this year, that's up to 50k total income, and then it's 20% thereafter. So with the entrepreneur's relief, you basically cut the tax in half once you're over this 50k amount. So actually, for a lot of businesses that do close their companies, so like smaller consultancy companies and things like that, it's possible that you won't even reach the higher rate tax threshold to pay this 20%, depending on what you've taken from the business. And in that case, it doesn't actually matter if you claim entrepreneur's relief or not, because you'll get that £12,000 tax-free amount, and then you just have to pay 10% on anything after that. That's a pretty good deal, I would say. And finally, what I've been waiting for is our example. So in this example, we've got a single director, single shareholder company, no other capital gains in the year. So we know it's not going to be interfering with our calculation here. Okay, so the company accounts were completed and the final distribution value was £15,000. And your initial share capital that you invested in the business was £1. So your total gain for the year is $14,999. Okay, basically £15,000, not going to make much of a difference. But anyway, the next step is to deduct the tax-free allowance of £12,000. So the remaining balance that will be taxed as capital gains is $2,999. And with the entrepreneur's relief, or if you're still a lower rate or basic rate taxpayer, then you only have to pay 10% on that, which is just under £300. So on this total distribution of $15,000 at the end of the year, you only have to pay £300 of tax, which is not that bad. So you can calculate whatever percentage that is, but it's not very high. Thanks to this $12,000 tax-free amount. And just remember that taking money before the year-end date will be added as a dividend. Or if you've got expenses owed to you or something, then it will be something like that. But it will not be a capital gain if you take money before the year-end date. So just keep that in mind. Don't make that mistake. If you're getting excited to take the money, just don't do it before the year-end date, because then you can't really change what that money was for. It can no longer be a capital gain. So this is an example for your personal tax. When you close a business, what happens to the money at the end and how you're taxed on that income. So I hope this video was helpful for you guys. And if you do have questions, please feel free to leave them down in the comments section. Thanks so much for sticking around to the end of the video. If you did find it helpful, then please do click that like button and also consider subscribing if you're interested in more content like this. And in the meantime, I hope you guys have an awesome day.